Greetings. In this particular video, we're going to take a look at how open market operations, one of the monetary policies of the Fed, affects bond prices and bond yields. A very important outcome from this analysis is going to be how ultimately the Fed's actions can affect interest rates in the marketplace. And what we're going to learn is that bond yields have an effect on other types of interest rates, particularly interest rates like mortgage rates. Mortgage rates are the interest rates on homes. So let's just go ahead and dive right in. In the last video, we took a look at how the Fed conducts open market operations, and we learned that the Fed buys and sells government bonds in the secondary or open bond market. By the way, this is Unit 3, Topic 2. We're in Unit 3, Topic 2 right now in the Course E workbook. But back in Topic 1, we took a quick look at open market operations and learned a little bit about the Fed and how the Fed goes into the secondary or open bond market, buys bonds or sells bonds, and ultimately affects the level of reserves in the banking system. In this video, we're going to look at how these actions affect interest rates. And then, of course, once we know how they affect interest rates, we can begin to put it together how they affect the macroeconomy. So if you take a look here at the notes that I've put up for you, and by the way, again, a commercial break from your sponsor, take notes. Take notes. The way you internalize this information is to write things out and rehearse it. I can do this lecture pretty much from memory because I've done it repetitively and I've written this information out many times. The more often you write something out and look at it and touch it, the more likely you are to remember it. Okay, back to our regular programming. So the Fed goes into the secondary or open bond market and buys government bonds. The effect of that is to increase the demand for these bonds. So really the Fed is out there competing with other bond buyers for these bonds. The effect of that is to push the price of these bonds up. It's just like apples. If there's an increase in the demand for apples, there's going to be an increase in the price of apples. And these bonds are like a commodity. The more demand for bonds, the greater the price of bonds. However, that increase in the price of bonds is going to have an inverse effect on bond yields. Bond yields, the interest rate, the effective interest rate on those bonds is going to go down. Now, let me explain this. This is a little bit, complicated. We're getting into some bond finance here. By the way, I'm giving you a very, very quick explanation of this. Again, if you want a more thorough explanation of this, you need to go to the e-workbook, Unit 3, Topic 2. But I'm going to get through some of the main ideas here, and this will help you dive back into the e-workbook if you want to do that. So if you have a bond that is paying an annual interest payment of $30, and you pay $1,000 for that bond, your current yield, it's called the current yield actually, is 3%. Now it's a little more complicated than this. That yield is going to depend on the maturity of the bond and some other things, and I show that in the e-workbook. But just very quickly here, you can see this idea that a $30 payment, fixed payment, remember these payments are fixed at the point of that bond being sold. And that $30 payment on a price of $1,000 yields 3%. Now, if that price were to go up to $1,500, that $30 payment doesn't yield 3%. It only yields 2%. So an increase in the price of the bond is going to decrease the yield on that bond. Mr. Sipsic, you wrote that already up here. Yes, I wrote it, and I'm writing it again to say to you, jot these things down. And jot them down again, and jot them down again. And the more times you jot them down, the more likely your brain is to remember them. Your brain has to be trained. It's just like lifting weights. You know, if you're going to train a muscle group, you've got to train it. You've got to make it work. And I will just, say that cell phones and electronic devices are great. I have one right here. Okay, I've got my own phone. I get it. I like my phone. I like what my phone does for me. But at the end of the day, phones can many times lead to the destruction of concentration and learning skills because you're just looking at things very quickly, kind of just stimulus, and you're not focusing on relationships, how things actually relate to one another. Okay, end of the commercial break. Now we can draw this situation using a supply and demand model here. And we haven't talked a lot about supply and demand in our macro course because really supply and demand is a micro question. The bond market is a specific type of market. But nevertheless, we can use some of this micro thinking to help us understand what's going to happen here to bond yields. So if there's an increase in the demand, let's say for 10-year bonds that are out there for 10 years, they're going to be out there for 10 years, and there's an increase in the price of those bonds. So different bonds have different maturities and different characteristics. Some bonds are not as risky, government bonds, some bonds are riskier, corporate bonds tend to be riskier, but they all behave the same way. If there's an increase in the price of the bond, that's ultimately going to decrease the bond yield on that bond. That is critical bond finance. So when the Fed drives up the demand for these bonds, the demand curve shifts to the right, it pushes up both the quantity of bonds traded, so the quantity of bonds traded increases, but so does the price of these bonds. They increase. Just like if there's an increase in the demand for apples, it'll drive up the price of apples and it will drive up the amount of apples sold. Simple supply and demand thinking. Okay? Now, let's keep going here. And what I did is I brought a table from your e-workbook. Okay, now this is found in Unit 3, Topic 2 of your e-workbook. And you can go there and you'll see the complete discussion around this. But I just wanted to point out to you, if you look at the time period 2003 to 2007, you see that bond yields were consistently above 10. This is 10-year bond yield, 10-year bonds. These are fairly long-term bonds. So these are 10-year U.S. Treasury bonds. If you were to look at the yields on these bonds, they were always over 4%, sometimes up close to 5%. In fact, just before 2008, these bonds were trading at yields of close to 5%. So people that were holding these bonds were generating effective yields of close to 5%. Why have bond yields dropped so dramatically from 2008 to 2022? Why? Why have these bond yields dropped so dramatic? These are dramatic. Look at in 2020, the bond yield was on the 10-year government bond was less than 1%. How did that happen? You now understand. The Fed was buying, we'll talk more about this in the e-workbook, the Fed was buying extraordinary amounts of U.S. government bonds. Why? To drive bond yields down. And why would the Fed want to do that? Well, that would help keep other interest rates down. Other interest rates would stay down because mortgage rates are usually built off the 10-year bond yield. That's a flag, if you will, a flagship yield. So other interest rates, this would push other interest rates down. Why would the government, via the Fed, like to see lower interest rates, say post-COVID? Well, because there was a fear of major recession. There was a fear of even depression. And the Fed was accommodating the work of the federal government. The Fed was trying to keep interest rates really, really low as the federal government was struggling with this COVID issue, this COVID pandemic. And economic activity was basically collapsing for a period of time in the United States and throughout the world because people weren't getting out of their homes, weren't traveling, weren't buying the same things they were buying. Fear was taking over and all of that. And the economic activity was slowing. So one thing the Fed can do to try to get people spending again is to lower interest rates. Now, this is going to be of limited usefulness during a pandemic because you can lower interest rates, but if people don't want to get out of their house and they're afraid, they're still not going to buy a new car or buy a new house. But nevertheless, the Fed was doing what it could to try to stimulate the economy by keeping interest rates very low. How did it do it? It did it by buying, listen to this, trillions of dollars of U.S. government bonds in that 10-year time period. Go back from 2022 all the way back to 2009, which was roughly a decade, and you're going to see that the Fed's balance sheet increased dramatically in size. What that means is the Fed bought almost tripled the amount of bonds it was holding in its portfolio. This is called open market operations. It's also called quantitative easing, and I talk about that in the e-workbook. Open market operations generally involve the purchase of government bonds. Quantitative easing has the Fed buying other financial assets like mortgage-backed securities. And I talk about this again in the e-workbook. You should take a look at it. Okay, so wow, in the news, economics in the news. That's what we're doing here. Now this video may be around a while, and who knows? The government may sell off some of these assets. We don't know. The Fed is not part of the federal government. Again, the Fed is an independent central bank, but the Fed may sell off some of these government bonds at some point, or just simply let them mature and not buy bonds to replace the ones it's holding. So we'll have to see what the Fed does with this enormous balance sheet having U.S. government securities on it. The Fed is one of the largest holders of U.S. government debt. And when the Fed buys U.S. government debt, what it's essentially doing is monetizing the debt, taking that debt into its possession and replacing that debt with what? With money. And that will lead to an increase. One of the outcomes of that will be a dramatic increase in the demand for bonds and a dramatic decrease in bond yields. Okay? It also makes credit conditions in the banking system very, very loose. So you saw interest rates in the banking system drop significantly around COVID, and it was due to the Fed's actions. Now, if the Fed wants to reverse this process, one way it could do that would be to sell bonds. And so let's just run this in reverse. We'll just do it very quickly here. If the Fed sells bonds, this, by the way, is rare. It's much rarer because the Fed's been building its balance sheet for the last 10 years. So the idea of the Fed actually liquidating its balance sheet, selling it off, is a rather uncommon thought. But suppose the Fed begins to sell off these assets. What would happen is this would lead to an increase in the supply of bonds in the bond market because the Fed would be selling off bonds that it already purchased. So now it begins to sell these bonds off, and bonds are now flooding the bond market. Well, that's going to drive down bond prices and drive up bond yields. You say, I don't understand. Well, let's go down to this little example here. And sure enough, the math is quite simple. Now again, these calculations are actually more complicated than this, and I show them in the e-workbook. But you can get the idea here, get the drift here, because the payment remains the same on this bond, $30 a year. But if the price goes from $1,000 down to $600, if the bond is sold and it's still paying $30 a year, that's the contractual amount it's paying, then the yield on that bond is going to go from 3% up to 5%. So if there's a large sell-off in these bonds and the supply of bonds dramatically increase in the market, then that's going to drive down the price of bonds and drive up bond yields. The effect of that, using supply and demand, would be to shift the supply curve to the what? To the right. That would drive down the bond prices, drive up the amount of bonds sold because you're flooding the market with more bonds. More bonds are being sold. But bond prices, the key idea here is bond prices are falling because of this increase in supply. And that, of course, is going to drive down the bond yields. Okay? Now, there's more to this, okay, of course. But this is very important monetary policy. Now, we're going to talk about what happens when bank reserves dramatically increase in these kinds of conditions, and the effect of that not only on bond yields, but on the other types of interest rates, and then on consumption, investment, GDP, and prices. But for now, we'll sign off. This is enough for one lesson, one video lesson. I hope this helps. Again, you might want to watch this again if something was bothering you, you didn't quite understand it. Of course, you're always welcome to jot down questions and get a hold of me if you're still in the fog on this. And of course, you've got your e-workbook where this is, and it's explained even more thoroughly than I explained it here. Okay, I wish you well. Take care.